Welcome to our Emerson Group community call for May. We're excited to have everyone today and super excited to get into the nitty gritty with Jordan and talking about 1031 exchange, some partnership considerations, and some really good opportunities for you that I'm confident are going to save you guys a couple $100,000, if not more, especially with where a lot of equity positions are at this point in time. I'd like to formally introduce Jordan with iPx1031. Jordan has over 15 years of experience with 1031 exchange and has managed over 10 billion in exchange proceeds. So fair to say he's qualified, he's experienced, and he's someone who's going to give you guys a lot of good information. So Jordan, I'll let you take it from here before I pull it back for a quick poll here in a minute.
Perfect. Hey, yeah, thanks, Nick, so much for having me on. Everyone, thanks for joining. As Nick said, my name is Jordan Phillips. I'm with iPx1031. And, today we're just going to kind of go over some of the real basics of a 1031 exchange, but more importantly, as the PowerPoint says, take a deeper dive into some of the more nuanced topics of 1031 exchanges, a lot of topics that a lot of our clients aren't even aware of going into the exchange, which, like Nick said, can really help create even a larger benefit while doing a 1031 exchange. Like Nick said, let's make this interactive. If you have any questions, feel free. Not trying to bore you guys, but like I said, hopefully we'll have some good education today and have a little bit of fun along the way. In simple terms, what a 1031 exchange is, it is a tax deferral mechanism. So whenever you're selling either real estate that's held as an investment or in the use of a business, especially in this market where appreciation is pretty high, there's a good chance that you're going to have a large amount of capital gains built into that property, which a 1031 exchange allows you to actually defer indefinitely by going out and buying other investment or business use properties. So by doing a 1031 exchange, all of these taxes, long-term capital gains, federal and state, net investment income tax, depreciation recapture, all of that is deferred indefinitely. So that is, that's the number one reason why clients do exchanges is to defer, obviously, paying these taxes.
So let's just get into the basics real quick before we get into some of the more nuances and details of the basic structure of a 1031 exchange.
Yeah. So doing a 1031 exchange really isn't a super complicated transaction. The IRS does impose certain guidelines, and there's really four main guidelines that you need to be aware of when doing a 1031 exchange. Three of which are on this slide, one of which, the last one, we'll talk about a little bit later in this PowerPoint. But the biggest one really are the timelines involved in a 1031 exchange. So the IRS says, okay, we'll give you the ability to do a 1031 exchange, go out, buy a replacement property to defer your taxes. But we're still the IRS, right? So we're not going to make it super easy on you. We're going to impose strict timelines. So basically, once the sale property closes, that's when the clock starts for the 1031 exchange. So from the closing of the sale, you would have 45 calendar days to go out and identify a potential property or properties to purchase. And you'd have a total of 180 calendar days to actually complete the purchase. So like I said, those timelines start the day after the sale closes, and they both do run concurrently. So the second requirement is that the property that is not only sold, but also purchased must be used as either an investment or in the use of a business. The last thing is also the purchase amount that you need to buy for to defer all taxes. So those taxes that we spoke about in the previous slide, if you want to defer paying all of your capital gains taxes, the property you purchase or properties needs to be equal to or greater than in value to the property you sell, minus any closing cost. So Next, I'd like to, as we spoke about potentially, what you can't do in a 1031 exchange is sell or buy your primary residence, right? So you can't sell your current primary residence, do a 1031 exchange. So I'm sure most of you guys are aware of this, but if you are selling your primary residence and you've lived in the property for any 2 of the last 5 years, the IRS actually allows for a primary residence exclusion. So essentially, if you file as a single filer, you can exclude up to $250,000 of taxable gain. If you file as a joint filer, you can exclude up to $500,000 of taxable gain if you're selling a property which has been your primary residence for 2 out of the last 5 years. So there actually is, back in 2005, the IRS allowed for the combination of Code Section 1031 and Code Section 121, which is the primary residence exclusion. So on this next slide, there's basically, like I said, Revenue Procedure 2005-14. So if you can actually meet the criteria of both Code Section 121 and 1031 at the same time. So basically, any 2 of the last 5 years of that you own the property would have to have been your primary residence. So that would check the box for the primary residence exclusion. Now, if you want to also qualify for a 1031 exchange, the last 2 years that you own that property, the property would have to have been an investment property. So I know the timeline is tight. So basically, the IRS would look at the last 5 years before you sold the property. Okay, so were 2 of those years as a primary residence, and were the last 2 years used as an investment? If so, you can take advantage of Code Section 1031 and the primary residence exclusion. So where we see this actually a ton is clients who are selling a property, a lot of times in the Bay Area, Northern California. So properties values obviously are very, very high. A lot of our clients, they might have bought a property in 1980 for a couple $100,000, and that property might be worth $3-4 million at this point. So they have a significantly more than $500,000 of capital gains taxes. So what they've done is they said, hey, look, I'm going to rent this property out for a couple years, sell it. So let's say they sell a property for $2 million, right? And they've got, basically $2 million of gain in the property because they bought it for such a low value. So let's say they sell for $2 million. It's been their primary residence in 2 of the last 5 years, and they've been renting it out the last 2 years. They could sell that asset, put $500,000 cash in their pocket for the primary residence exclusion, and then they can defer the rest of their capital gains taxes by going out and buying an investment property. So basically, if they sell for $2 million, put $500,000 in their pocket, to defer the rest of their gain, they would have to buy a property for $1.5 million or more. So we see tons of clients, sell in the Bay Area, come down here, maybe buy a property in San Diego that they want to have as an investment, and they can do that through a 1031 exchange. So combining 1031 and 121 is definitely possible. So the IRS actually in 2008 came out with guidelines as far as how to actually purchase your primary residence through an exchange. So we have, there was a lot of investors out there selling a property, doing an exchange, buying their replacement property, and then moving in 6 months, a year. IRS says, hey, look, because we have so many clients, or not clients, but taxpayers who are doing this, we're actually going to provide black and white guidance of how to actually be able to move in to a property after you buy it through an exchange. So essentially, any property that you buy through an exchange for the first 2 years, it would need to be used as an investment property. So basically, in each of those first 2 years, you would have to rent it out for at least 14 days, not very challenging, but you'd also need to limit your own personal use to essentially 14 days or less. So if you do that in each of the first 2 years, rent it out for 14 days, limit your personal use to 14 days or less. After the 2 years are up, you can move into that property, have it as a second home, whatever you would like. And after that 2 years, the IRS could not actually challenge the validity of the exchange. So as we spoke about before, there's basically 4 major requirements when doing a 1031 exchange. The ones we spoke about, timelines, property type, purchase amount. There is a 4th one. It's not the sexiest of topic, but it is very important, is in order to actually have a valid 1031 exchange, the taxpayer needs to remain consistent from the sale to the purchase. So basically, if you are selling as individuals, or if those individuals have their own LLC that's disregarded for tax purposes, would need to buy the property. If you sell as a corporation, that corporation would need to buy the property. And where we see this come up a lot of times as issues is if you're selling as a entity tax as a partnership. So what that would be an LLC or a partnership itself that files its own separate tax return. That entity would then need to go out and buy the next property. So that if there's any, typically these are vesting issues, right? So basically the taxpayer needs to remain consistent. If there's any issues where this comes up, it is like a multiple member LLC or a multiple member or multiple partner partnership wanting to sell as the partnership or LLC and go out and buy as individuals, which would not work for a 1031 exchange because the partnership and the individuals are separate taxpayers. So that would invalidate the exchange. So there are some ways to work around that, which we'll go over here. But if those vesting issues come up at all, that's typically where they come up.
All right, so the other one is continuing on to just some of the other details or nuances for the partnerships. Perfect.
Yeah, so as we spoke about, we have lots of clients, maybe they own a property with their siblings or friends, and they might have an LLC or partnership in which maybe, let's say, for example, there's 3 members and 2 of them want to do an exchange and 1 wants to cash out, or 1 wants to do an exchange, 2 wants to cash out. And this causes a real issue, right? Because you have these differences in these parties on what they want to do going forward. And as we spoke about, if that partnership itself sells, it also would need to go out and purchase the next property. So when you have, oftentimes, we have clients who've owned properties together for 10, 15 years. And at the end of the day, they're just flat out sick of each other. They don't want to go forward. They don't want to buy a property together. So those are the scenarios we see. And next will be kind of ways to work around that, because this actually comes up a lot more often than you think. The first one would be, so this would be the scenario which if most of the partners in the partnership want to actually complete the 1031 exchange together. So there's 2 ways, and these are both pretty clean ways of doing it. Let's say, for example, you have a partnership with 5 partners, and 4 want to go out, do an exchange, and 1 wants to just cash out. There's really 2, like I said, pretty clean ways of working around that. One way would be is you could just flat out buy out the 5th partner. Just say, hey, look, here's money, go away. We're just going to go on and do the exchange without you. That would be the cleanest way. The second way would be, a lot of our clients don't have the funds to actually buy out the 5th partner. And what you don't want to do is buy out that 5th partner with like the sale proceeds, for example, because that would create what's called taxable boot to the entire partnership. So this comes up a lot. It's basically what's called a redemption agreement. So let's say you have 5 partners in a partnership, 1 wants to cash out. Let's say they all own 20% of the partnership. So what would happen is the 5th partner who does not want to do the exchange prior to the sale closing would redeem its 20% interest in the partnership for a 20% interest in the real estate. So prior to the closing, the partnership would be on title as tenants in common with the individual. So the partnership would own 80% of the property. The cash out partner would own 20%. And then once the sale closes, the partnership could do its exchange with 80% of the proceeds, go out, buy its next property, and then the one partner who wants to cash out could take its funds and pay its taxes. This comes up a lot, for example, like with siblings, they might own a property together. Maybe they inherited the property from their parents 10 years ago, and one of the siblings might need some money for whatever, medical expenses, college tuition, and they don't want to actually do an exchange. So they could be carved out essentially prior to the closing, and then the rest of the partnership would then go ahead and do an exchange. So that's easy. That's easier for sure if most of the partners want to do the exchange to get that done.
So thank you guys. I'm looking forward to next call in June. And of course, have an awesome rest of your week. And Jordan, thank you very much for your commitment of time and your education. We appreciate it.
You got it, Nick. Thanks for having me on.
All right, everyone, have a great rest of the week.
Thanks.